Let's get MacroMavens President Stephanie Pomboy's opinion here. Stephanie, great to see you. Welcome. I want to get your take on the macro story. Cheryl just reporting a slight miss on the ADP numbers. Job creation of 44,000 versus an estimate of 70,000.
Yeah, surprisingly soft, and the expectations for payrolls this week are, 80,000, which again is sort of on the softer side of the size gains we'd be liking to look at. And it's interesting because I was looking at an overlay of capital spending versus employment, and as you'd expect, normally they move together. And we've got obviously CapEx growing well into the double digits year on year, while employment growth is really, I think, 0.3% year on year. So it's a very unusual divergence. And I guess, maybe part of that speaks to the productivity involved in this whole, very technologically advanced CapEx boom. But it's a problem in terms of getting that engine of growth for the economy, the employment side really strengthening. And the fact that it's taking place also against a backdrop of these resplendent corporate profits is another sort of, a troubling facet. You'd think with 50% growth in profits and this boom in CapEx, then employment growth would be phenomenal, and it's not. So this ultimately becomes a problem in terms of the long-term trajectory for consumer spending if we're not going to get, solid labor income. So very much something to keep an eye on.
If we see the numbers on Friday mimic this, Adam, do you think that the Labor Department's July jobs numbers will mimic what we're seeing in the ADP, which is a slight miss?
That is the pattern that you typically see, which is why people pay attention to ADP. And yet it's still growth. It's just a question of how much growth. We created, what was it this morning, 40, what was it, Cheryl, 40, however many thousand?
44,000 private sector jobs.
We created 44,000 jobs, right? Yeah. Let's not, let's not fumble the ball. Let's not turn a win into a loss.
4.4% growth in pay year over year, according to ADP. That's a good number.
Yeah, that's certainly good for wages. Well, you've got more earnings on the way, Stephanie. CVS, Disney, Uber, Eli Lilly, all reporting this morning. Lilly reported a strong quarter, raising its annual revenue forecast as the obesity and diabetes drug demand is strong. SpaceX also reported a beat in its first quarterly report. Of course, they lost money, but it was less than they thought. Strong AI revenue results and forecast also. But, of course, the lockup period has begun. Lockup expirations began after the company's second quarter report last night, and the lockup timing is well known. Expectations have put pressure on this stock because they're expecting insiders to start selling. Stephanie, your thoughts on the backdrop in terms of earnings? I know you've been worried about a competition for capital versus the government and private investors, right?
Yeah, well, speaking of the lockup, we have this situation now where the stock market has shifted from having this wonderful tailwind of share buybacks that were exceeding $1 trillion a year to now having a net issuance, led primarily with the SpaceX IPO this year. Issuance is up 170% year on year. But the point is that we've gone from an environment where the corporate sector was really one of the main purchasers of U.S. equities, supporting the stock market via these buybacks, which simultaneously, by the way, serve to inflate earnings per share metrics since they're based on, the number of shares. So that has been a tremendous tailwind, and it's now turning the other way. At the same time, as you mentioned, we've got this massive debt issuance tied with this CapEx boom because a lot of the big companies, the hyperscalers, et cetera, have burned through their free cash flow and are now turning to the markets and saying, we need to borrow money if we're going to keep this expenditure at this pace. And in the background, you've got the U.S. government trying to roll $10 trillion of paper, which is, an enormous, obviously an enormous sum of money. And we've never had this kind of chase for capital ever in history. So this is going to be something to watch. It's already putting upward pressure on bond yields across the spectrum.
Stephanie, let me switch gears for a second, because the Japanese yen is up about 4% against the dollar since the announcement on Friday that the U.S. was going to support Japan and intervene in markets. Your thoughts on what has taken place here? Because, we spoke with Nick Timmeros earlier in the Wall Street Journal, and he writes, Bessent's request represents an early test of how Fed Chairman Kevin Warsh, who took office in May, intends to draw the line between the central bank and the administration that installed him when it comes to things like intervention and supporting the yen.
Yeah, well, I think that he's getting involved in part because the issue is that when Japan on its own attempts to support the yen, it does it obviously by selling dollars, which in turn means they're selling U.S. Treasuries, which was putting additional upward pressure on long-dated bond yields. So he's now using the ESF, and I think what he did was actually sell euros in exchange for yen in this intervention. So it's a way to reduce the pressure on the long end of our yield curve that was being placed by this constant Japan intervention. So it makes sense that the U.S. is trying to get involved to tamp that down.
Stephanie, it's great to get your take on all of that. Thank you so much. Stephanie Pomboy,
Thanks,
MacroMavens. We'll be right back. Stay with us.